Welcome to the Farming on Purpose podcast, a podcast for farmers and ranchers ready to shift for a stronger future. Today's challenges in agriculture are new, but the grit and determination required to be successful are not. On the Farming on Purpose podcast, you'll hear how producers of all sizes and practices are moving mountains for things they believe in, all in the name of an industry that keeps growing and innovating for a stronger food system and stronger farm families. I'm your host, Lexi Wright, and I'm excited to discuss where producers are finding success, challenging the status quo, striving for better, and keeping our heritage alive, all while producing the food we depend on. Welcome back to Farming on Purpose. Today I have Tressie Mitzner with me. And Tressie, I've known for quite a while, since my days of briefly teaching high school ag in Hill City. Tressie has a fun background of lots of experience on the topic we're going to talk about today, which is year-end tax planning, but also a cool story, I think, about just how you guys have evolved to be able to build your operation. So Tressie, welcome to the show. Tell us a little bit more about yourself and how you got to where you are and what you're doing now.
Sounds great. Well, I want to thank you, Lexi, for having me on today. I have been listening to your podcast probably since the very first few episodes came out. I don't even remember how I stumbled on it. And I'm like, oh, how exciting. This is going to be so good. I have really enjoyed listening to all of the input and all of the great people that you've had on your pod. And it's just an honor to be a part of that conversation with you. A little bit about my background. My husband grew up in South Central Kansas around the Larned area. His family had a stocker calf operation. And later on, as he grew up and was kind of heading off to college, they did do a registered cow-calf operation. And he kind of was the one who got us into Gelbvieh cattle. And my family is from Northwest Kansas, so I actually brought Levi back to the area where I grew up. My dad was in farming and ranching and had a custom hay business, so I grew up spending a lot of hours on a swather, a baler, bucked a lot of hay growing up, and said that I would never do that again. But here we are, and I'm absolutely loving it. Levi and I met in college and knew that we were going to land somewhere together. I felt like I got to marry my best friend. We were on the livestock judging team together and worked at the livestock units at Fort Hays State University, and literally were best friends before we bit the bullet and decided that we wanted to spend forever with each other. Mm-hmm. And as we were trying to find something to do, both of us had a lot of different opportunities in a lot of different areas, and we found ourselves was at Seaboard Foods in the Holyoke, Ray, Julesburg area. So we started with them right out of college as management trainees and company provided housing. And it was just an incredibly eye-opening experience to work in the hog corporation, totally integrated from farrow, not just to finish, but they have the facility in Guyman. It's the processing location, and they own Daly's Bacon. And part of our training process was to learn every piece of that before they put us in management positions. And we both landed in management positions pretty quickly. After 7 months, I was managing a fairly large sow farm, and Levi was in charge of some nurseries and finishers up in the Holyoke and Ray area. Of course, we're married by then, and our first child, Tatum, was on the way. And we just had we wanted to get back closer to home and closer to family to raise our kids. And that's kind of what brought us back. It took us a long time to kind of move back, what I would call home, but we landed in Grinnell, and Levi was a feed mill manager. And I was an extension agent after I realized that I was not cut out to be a stay-at-home mom. In the midst of that, we had a very dear friend of ours. Our family had been doing business with them for a lot of years. And they gave us this incredible opportunity to, if we purchased their cows, we could rent their grass. We sat at the kitchen table and took a deep breath and thought, we could do this in cash if we would save for 10 years, or we could get into this right now with this incredible opportunity. And financially, it does not make the most sense, but it's the opportunity of a lifetime. So we closed our eyes, and with only a extended cab, 3/4 ton pickup, got ourselves back into the cattle business. So that was in 2008, and here we are. So we were really blessed. The gentleman's name is John, and he helped us get started in so many different ways, and that included renting some of his equipment, so we didn't have to go and purchase everything. It was kind of funny. We owned a couple of hundred cows before we bought our first tractor. I mean, the first piece of equipment we purchased was a 20-foot rusted out Titan trailer. It was cheap and it got our cows where we needed to go. At that point in time, all of our grass was continuous, so we really didn't have to move pasture. We just did everything, moving to calving pastures and to summer grass just by horseback or four-wheeler, and just started accumulating assets as slowly as we could, so we didn't get too many overheads for our operation that we couldn't, make our payments. And my favorite saying nowadays, is I'm trying to teach some of the kids in an ag business management class, is if cash is king, cash flow is queen.
Yes.
So you really have to stay on top of those couple of things. Levi and I have always had an off-farm job. He's very gifted at machinery and equipment repair, and he's worked for several different companies along the way. And I have occasionally worked for Extension. I have an animal science degree and an animal science background, and it's so funny that I ended up in the accounting world and crunching numbers. That's nothing I thought when I stepped out of college that I would ever be doing. But when the 2014 Farm Bill came along and extension agents were helping producers make those ARC and PLC elections, there was this matrix of a spreadsheet that you could put your numbers in for your operation. You could see what you were more comfortable with, if you wanted county payments or price loss coverage, kind of like a safety net under the price. And I just really enjoyed working with producers, sitting across the desk at the extension office, helping them build their business. And so I went on to do some more professional development that was learning how to run a program called FinPack. It was unique in that you could build balance sheets and cash flows, and it gives you up to 14 scenarios that you could put in for your operation to, like, if this, then what happens? If I add cows, if I take away cows, if I sell a tractor, if I buy land, what does that do to my operation? And that training was just eye-opening. I just had never dug into the financial piece of the operation like that before. And I knew that that was where my God gift was.
I think it's great just to know more of your background and your story, because that gives you a lot of insight into what you do now and what you are working on, helping providing these resources. I love that, that you mentioned the scenarios there of all of the different things you can kind of evaluate on your operation of okay, well, what happens, we feel maybe under equipped. What happens if we buy a tractor? What does that look like 10 years from now? And there's a lot you can evaluate with that. And I think that is a tool that is probably underutilized by a lot of producers, because we just don't think that way. We don't know that, that's even an option to evaluate that. So I'm excited to hear more about kind of that forward thinking and the advice that you have for folks as we kind of look at what we're going to be doing in the future. I think tax planning is obviously always a time where producers are like, okay, this is the deadline. I've got to look at all these numbers again. So it's a good opportunity to, for one, plan for your year-end wrap-up and your taxes, but also look down the road, look further ahead and think, okay, what can I do in the next year so that this situation is favorable for me at this time next year? Let's start kind of getting into the meat of this topic and talk about your year-end wrap-up tips and kind of where we get started with those things. We do have a disclaimer here that Tressie is not technically able to give financial advice, so please consult your accountant and your tax preparer. Every situation is unique. We don't want you to take information that we're going to give you and just blindly
Run with it.
Yes. So
Right.
this is informational and educational purposes, but I think you have a lot of great stuff to share. So let's dive in.
Sounds good. And before we go, I just want to give a lot of credit to Kansas Farm Management and our first economist. His name is Todd Ziegler, and he is an absolute saint, because when I started down this journey, I literally did not know how to reconcile a checkbook in QuickBooks. And to see how far I've came since 2009 when we started working with Kansas Farm Management, and all of them helping us guide our business, and then through a variety of paths and valleys, and I landed as an economist at Kansas Farm Management after I was a farm analyst for CAMS, Kansas Agriculture Mediation Service. Knowing that like those were the things that I enjoyed doing, sitting across the kitchen table with producers. So over the years and working with people through CAMS and KFMA, this is kind of a list of what I feel like we should be thinking about. And I would say we're sitting here right before Thanksgiving in November, and I really hope that producers can make a habit of starting to think about their tax plans more like in the August timeframe. You're really wanting to kind of set your year and kind of know what's coming up earlier in the season. I had a banker tell me one time that his most successful producers come in with a tax estimate to him in August or September. So, we're a little bit behind the eight ball in this conversation this year right now, as we're going to talk about tax planning. We're going to talk about even more than that, but I think it's great. You've got to start somewhere, and this is the perfect place. Let's kick it off with just talking about year-end wrap-up and what you should be doing as a producer to get prepared for this sliding into the end of the year and January 1st, January expectations. Mm-hmm. And I would say that the number one thing that you can be doing to help yourself is getting your 1099s and W-2s ready. Your W-2s, if you're paying your employees clear through the end of December, you can't have those numbers finalized, but you can definitely be looking and making sure all your names are correct. Your social security numbers are correct. You haven't had any red flags or anything. Your addresses are correct, and your dollar amounts are correct. If you're entering your transactions throughout the year, then you should be able to pull up your 1099 report and make sure that those numbers is like, okay, yes, I did pay, ABC Harvester for wheat harvest, and that total amount was $6,000. Or wait a minute, I paid him in 2 checks, and that should be $16,000. Mm-hmm. So we really need to be paying attention to those amounts. It's easier to catch it before you turn those sheets in, rather than when you get it at the end of January and you're trying to send it out and you're like, oh my goodness, this number's not right. And the corrections on your accountant side of things, if you're not doing those, it's a little more difficult to submit corrections, right? Just remember that is $600 and over for contract labor, for pasture and farm ground rents, interest that you're paying out. For instance, if you have a loan from somebody who's helping you get started in business, maybe you're purchasing land from a family member and you're paying them a little bit of interest to individuals or something, you need to have those amounts sent out as a 1099 interest.
I want to touch on this just a little bit more, because I know there's resistance to doing this specific type of form with folks, because they don't want to ask their buddy that's down the road that baled their hay if they can send them a 1099. Why is this important for both parties?
Sure. Well, we want that as a tax deductible expense for starters. And a lot of accountants, and kind of what I've seen, is they're not going to let that be a deductible expense if you're not sending out the proper 1099s. Remember, there's a $500 per form, not just like blanket, but per form non-filing penalty. And most people don't realize that when your accountant is doing your taxes, they're filling out a whole bunch of checking the boxes, right? And one of the check boxes that they have to select is your business required to fill out 1099s, whether it's a Schedule F or a Schedule C? Like maybe you have a side business that you're doing some other work besides straight farming and ranching, and your accountant needs to check, yes, they're required to fill them out. And they also have to check, did you file them? Yes or no. And if you're not sending those forms out properly, then you're putting your accountant at risk for their license if you're not sending out the proper forms for your business. Don't ask your accountant to do that. That's just not fair on their part to have them filing your taxes, and you're not following through with filing the proper forms.
And I think, that amount being $600, it brings so many things into the picture that maybe aren't there when that number has been higher in the past or maybe will be again in the future, calling your buddy and saying, hey, I need your social security number to put on a 1099 so I can send you this form when all he did, was bring you a
Skim
load of
through and
hay. Yeah.
yeah. Uh-huh.
Um, it's just a
Yeah,
hard conversation, I think. So
trucking of ag commodities does not require a 1099. And that has been debatable. And I have some accountants that I know that are like, it's contract labor, but it is in code. And I should have looked up section code, but I do know that it's in code that trucking of ag commodities is exempt from 1099s.
okay.
So that's really interesting, and one that, you know, you have to just respect what the accounting firm, what they feel like their interpretation of that is, and respect that. And we can just give you an update on that. In 2026, that number for contract labor rents, all 1099s, will go up to $2,000. So from 600 to 2,000. And we're all kind of singing hallelujah in that,
Yeah.
because there's that gap is huge. You wouldn't
Yeah.
believe how many, just increasing to $2,000, that will, the buddy who's just hauling one load for you, or somebody who comes and does an on-farm repair that, takes them just like an afternoon to do. And you're like, oh, but it was $650,
Yep.
So I feel like that $2,000 is really going to help producers out. In 2025, we are still at the $600 and above, and 2026 will be at 2,000. So that's an exciting change that's coming down the pipe.
Yes, thank you for diving into that a little more. So that's kind of on some specific form pieces. What else do we need to be looking at that year-end wrap-up time?
I always encourage producers to really, if you can, print off your profit and loss detail report and just go through every line and just make sure things are in the right place. Like, for instance, here I am, I'm talking about having this position, and I printed mine off not that long ago. And I noticed that I had a crop insurance expense in the income section. And had I not printed that off and taken a look at it, I would have handed that into my accountant. And, those have to match up with your insurance 1099. So I'm sure that they would have caught it. But I just think it's very respectful of us to have our books in order, our transactions in order, and try to have those pieces of the puzzle in the right place. So if at all, try to, whether you're doing that quarterly, but at a minimum annually, really review those profit and loss transactions and get through those before you hand them off. And then I would really suggest, I know some people are entering transactions as their bank statements come through. That last one in January is super difficult because you've got, rents and all these things that you're sliding into the end of the year, and you're writing some checks there at the end of the year. And a lot of times they're not going to come through until your January statement. So I would really try to make sure that you get all of those checks that you've written at the end of the year, even if your bank statement hasn't came through, just so we don't miss something on like a 1099 report. But then my philosophy in preparing a tax return was always like, I'm not going to prepare your tax return until you've got your January and depending on where your statement falls, even your February statement reconciled, so we don't miss anything. There's nothing worse than you've written a big check to the chemical and fertilizer company, and your check hasn't cleared the bank, and you miss it on your expense side of things, and you were really banking on that expense for tax planning or whatever. So reconciliations, in my opinion, if you're doing your own reconciliation and not paying your accounting firm to do those, if you are, make sure that you give them your end of year checks if anything's going to come through that's a 1099.
Okay, so that's some things we can check. And I like that you talk about the timing of this because I think that's important. And it gives a little clarity why that August, September timeframe is important, because it lets you get such a big chunk of the year done. And then really moving forward from that, you're just looking at that final quarter of
Right.
things to document, and you have a pretty good guess of where you're going to land. What are some other things we need to look at then, thinking past maybe those transactions and profit loss details?
So beyond your ordinary income and ordinary expenses, I think it's important to double check your capital assets. And I could tell you horror story after horror story of capital assets not being recorded in whether it's a manual book or in QuickBooks or I've had some families that will even turn in like an Excel spreadsheet with income and expenses, but KFMA was pretty, you're in QuickBooks and you use QuickBooks, and we'd even translate our manual books into QuickBooks. So, but double checking your capital assets. So anything that you're purchasing and selling as far as machinery and equipment, cattle, land, and make sure that those are in your books correctly. When we are posting trades, we need to make sure that if we're trading a trailer and we're putting a down payment on the trailer in addition to a trade, that like all of those are coming through in our bookkeeping correctly. I had a gentleman who I was driving, I'm going to these people's, a lot of times their offices, and sometimes we'll sit at the kitchen table, and I'm kind of looking at their machinery and equipment lineup, and I get to their kitchen table and we're like reviewing last year's assets. They're a new client to us, and he's got a sprayer purchase for $10,000. And I've been very blessed that I could not tell you the numbers on sprayers and swathers and combines and tractors, but I kind of have a general idea of the value of things. And so I asked this gentleman, I said, I'm looking at your balance sheet from your previous accountant, and I'm noticing that your sprayer is on here for $10,000. I'm just taking a wild guess, but I can guarantee that that is not a $10,000 sprayer sitting in your equipment lineup. And he's laughing and he's like, nope, that was a down payment. This was the actual amount. And I said, well, I think we might want to amend your return because we're missing about $90,000 worth of a depreciable asset on your schedule. What had happened is the check came through at $10,000. His accountant and bookkeeper entered it as $10,000. If you're not sure and you're not seeing some of this stuff as the accountant or the bookkeeper, then some people do pick up a $10,000 sprayer.
Sure.
But I think it's our responsibility as producers to make sure that those total amounts are entered correctly. And a lot of times, not that it happens. I mean, it happens more frequently than you realize, that you'll get a loan for the entire value of a piece of equipment, and there won't be any down payment, or you've got some kind of special deal, 0% financing, 0% down on a vehicle or whatever. We need to make sure that that's set up in your books correctly, that the total value of it is in there, and then you have a loan set up in your books so we can see everything that's happening in that.
I think that makes sense. Just the amount that left your bank account that year is not the value of the equipment. It is.
Yes.
There's more to that story there with your
Yes.
loan payments and how that's set up. And then, of course, the interest paid and all of that has to be documented.
Right. So just remember, as you're making those principal payments from year to year, you really need to make sure as you're making those loan payments that principal and interest are split, because your principal payment's not deductible, right? It was a deduction when you purchased the asset, but you need to split off the interest payment because all of that interest that you're spending on farm assets is deductible, whether it's land, machinery and equipment, cattle, vehicles, farm vehicles. That interest is deductible, and you want to make sure that, don't ask your accountant to be chasing down all of those papers for you. Like, please have them, like, I have X number of loans, I have X number of interest splits in my books, or I have the sheets. We had a funny thing, us personally. Our bank, they'd kind of been bought out. They had done their banking system had a changeover, and they did not spit out interest statements for any of our loans. I think one of our loans. And so I knew that I needed to have interest statements and to double check all of my principal and interest splits. And so they had to manually go in and print out 1099s for each of those other loans. And I know it was a thorn in the side. It was a very busy time of year for all of us, but sometimes, it's our responsibility to be paying attention to all of those things.
That's a good point. Like, this is something that you should get from your bank in the mail, or, but not always. Sometimes things happen. So having maybe like a checklist of things that you can just verify, like, okay, I got this in. We both know not all QuickBooks setups or bookkeeping setups are perfect. Most of them aren't. So just kind of having some things that you can cycle through, like, okay, check, these things are taken care of, is good. Okay, so that's kind of on the expense side. What about on the income side?
On the income side of things, as you're selling assets, you need to make sure cattle sales are listed correctly. Remember that calf sales are ordinary income, and cow sales or bull sales, unless you're a trader, unless you're into the trader cow business, those assets are going to be categorized differently. And so you need to make sure they're split apart properly. I know a lot of times we have one sale barn that will list, they'll send a check for calves out the door and a check for cows out the door. And we have another sale barn that we do business with that it's all in one.
Mm-hmm.
So I really have to pay attention and make sure that I get calf sales and cow sales entered separately in my books. The other thing that you're going to need to pay attention to is cow sales, whether they're raised cattle or purchased cattle. And a lot of accountants have a first in, first out policy on cows. I had a client who everything was in his books as a purchase cow sale, purchase cow sale, purchase cow sale. Well, he'd been saving back replacements. And once we got to the end of all of his purchase cattle and there were no more purchase cattle on his asset schedule to sell off, he was in 1 year ended up selling off all his raised cattle, which there's 0% investment in those, salvage values. So in that particular year, it kind of just was a trip up on our part. And me, as being a new economist at that time, you really want to try to have a balance of raised and purchased. If you can have just a general idea and pull those off of your depreciation schedule properly, it's going to be a tax benefit for you in the future instead of just selling everything off as one or the other in one lump sum. It can mess up your 4797 and your gains. Remember, capital assets are taxed at a lower rate than your ordinary income. So you want to just make sure that you're catching that properly for your depreciation schedule.
And that's one of the things I think where we really see the value of tax preparers that understand agriculture. Because if you take your Schedule F and your books into, just your local H&R Block or whatever, they may not have this awareness. And so for folks that are maybe, young and getting started and they haven't had to deal with this piece of it before, that's something that's important. So it's good to kind of have that awareness, like this is recorded separately and this is why it matters, because it's going to affect you years down the road potentially in how you're keeping your records.
I think so often how God had just like such a hand in Levi and I getting started, right? If I was to go back knowing what I know now, I hope that young couples or even people they've had a career their whole lives and they're deciding to get started in the agriculture industry, and you've had a tax preparer to put in your W-2 for all these years, I think it's really important that you sit down with your accountant or somebody that you're looking at doing some accounting work for you and just make sure that they understand the agriculture industry. You just hit the nail on the head right there. It's okay to ask them questions and to make sure that they can help explain things to you, and that they're going to be able to take the time and sit down with you and do tax estimates. I cannot tell you how many times we've gotten new clients and they are like, what are we sitting down? It's not after the first of the year. Why are we sitting down? And I'm like, well, part of our service is that you're going to get, an initial tax estimate in August, and you're going to get a tax estimate, sometime, or like a final tax estimate in November. So you kind of have 2 times to get your mind around how you're going to head your business into the end of the year and make sure that things come together properly. So you're sitting where, just at the right spot, and you can make good decisions as you come into the end of the year. And right now, I think there is a tremendous challenge in the accounting world of being really short-handed. There's a tremendous amount of retirements, and they're trying really hard to get young people to come to that field. And it's a stressful field to be in, just like agriculture production. And their year is extremely loaded, right? And I completely understand that, but don't just settle for somebody just because you want taxes done. Make sure that they understand ag production and ag accounting.
And as a growing operation, I mean, I personally can vouch for how important that end of the year meeting or before the end of the year meeting is, because you can make decisions that really utilize, I mean, you have to be careful about spending money to avoid taxes. That's not the goal. The goal is to utilize the funds that you have in the best way to benefit your operation. And that meeting can be incredibly important when you're an operation that's growing or changing and to make some really good decisions there at the end of the year. So let's talk about maybe some of those decisions that you might be making, changes to your operations like purchasing land or building new buildings or new fence. What do we need to be knowing about those?
We'll just start out by saying if you're going to make a land purchase, one thing you need to be conscious of is there is some land is not a depreciable asset in terms of tax depreciation. Land
Mhm.
itself is not. But if there's newer fences, buildings, water systems, and irrigation system on those assets, you can depreciate those. Now, I would just say you don't want to elevate that asset value to be astronomically high and then have a land value that's super, super low. That's counterproductive. If you end up ever selling the land,
Mhm.
your basis in the land is going to be much less than what it truly is. So really try to leave the land value at fair market value, but you can depreciate some of those assets on those improvements on the land, and that can be set up in your books to reflect the value of the land and the value of each of those assets. I would just say that buildings, every capital asset that's on your schedule has a different amount of time that you're going to put it on your depreciation schedule, and the list is fairly long. For instance, buildings, farm buildings are 20 years, livestock buildings are 10 years, semis are 3, used machinery is 7, new machinery and equipment is 5. All different assets have different life calculations on the depreciation schedule. And just remember, it's a little bit different than when we're thinking about an asset that depreciates in terms of useful life. We're talking about tax depreciation, not useful life depreciation.
That can be frustrating sometimes
I
when
know
you
my
think
husband
about
and I
it.
my husband and I get into it all the time. He ribs me all the time because I'm like, up until this year, so tax minded, and we'll be talking about how long will this tractor last or whatever. And
Yeah.
I'm like, well, I can tell you that it's 7 years on the depreciation schedule.
Yeah. Well, I think that gives us a pretty good idea of, these are the things we need to be keeping records of. And that's really just the bare minimum of what we have to be doing here. Going past that, then we're starting to get into, I call it tax strategy. I don't know if that's what you're supposed to call it, but
I love that term. Yes, yes, that's
kind of
good.
planning and trying to make the decisions you need to best set yourself up for how your taxes are going to come out that year. But before we go into that, I want to close this door on the record keeping portion of it with something that I know happens to too many people, and that is we get to the end of the year and oh crap, we didn't keep our records, or maybe I'm, newly married on an operation and great, now it's my job to make sense of this receipt box. What kind of tips do you have for the folks who are in that position?
You just have to tie yourself to the office chair and make yourself do it. When Levi and I first started, there were so many late nights that we'd spend trying to make sure that our records were in proper order. And we just, over the years, have told ourselves and tried to train ourselves that we're going to try to keep those up. And entered, I absolutely love, I just converted our system to QuickBooks Online. So I'm almost entering our transactions daily as they come through, as I'm linked to my bank accounts, and I really like that system. But when we were in desktop, I was trying to get set down at least once a month. And I know when you get into spring or when you get into harvest or, calving season, it seems like some of that stuff slips through the cracks. You just have to find the method that works for you and sit down on yourself, whether it's every Monday or every couple of weeks, or when you get that bank statement, so you can get things entered, and then try to sit down quarterly and review those transactions. It's just a good habit, and you just have to develop the habit.
And it can be challenging, I think, when you are facing maybe that first time of like, oh no, we didn't do this the good way. So find a good audiobook to listen to or promise yourself a glass of wine at the end. My tip, I guess, is if you have to be sitting there doing something you really don't want to be doing, try to pair it with something that you like to do. So I do all my work at the kitchen table. So I put cookies in the oven and then I can't leave the kitchen or I'll burn the cookies. So I
There
have to
you
sit
go.
here and do my
Yep.
darn numbers.
And when we first started out, our kids were young and I could not concentrate and back and forth and back and
Hmm.
forth. So when the kids were itty bitty, I would put them to bed and I would work on my books for a couple hours,
Hmm.
and try not to get too late into the night because I realized I was making a lot of mistakes as I got tired.
Yeah.
I have always been so grateful that Levi's always come alongside me, even though like this is my main gig,
Yeah.
my contribution to the operation. But he's always been really good about backing me up and taking a look at things and making sure that we're double checking each other. And let me tell you, I mean, when we still to this day, and I'm sure like even though I have this background, I'll hand off my stuff to my new accountant and he's still going to find errors and things that need fixed. And we have to give ourselves the grace
Hmm.
that, I mean, put as much effort into it as you can and put the time into it, but know that we're human and we're going to make mistakes and that's okay as long as we're like learning and progressing, and every year our books are getting better and better and better. So give
Hmm.
yourself that little bit of not a buy but grace.
Yeah,
That's the term that
definitely.
we need to use.
And it does. It really helps to have somebody there checking your numbers because sometimes they do all start to look the same or get a little confusing. One other thing I'll say on the record keeping before we kind of move into the strategy thing is something that has helped us a lot is deciding that certain purchases go on certain cards or accounts because it makes it much easier to track. So for us, we have multiple businesses. So keeping all of those business expenses separated by entity and having actually separate accounts, which you might think is a great idea, but it's not obvious to everyone because sometimes we take a little while to figure that out. Having separate accounts for your different entities or different things that you're tracking makes it so much simpler when you're potentially sitting at the end of the year with a giant stack of transactions to go through that you don't know.
Right,
If you at least
right.
have it separated by entity, then it gets a little
Yep.
bit simpler to figure out.
And a lot of accounting firms will have like a spring check-in, and that would like, because for those that maybe are, just doing an end of year check-in, that's a long time to remember back.
Yeah.
And I mean, I remember thinking when our business was really small, this is so expensive to be paying for this extra level of membership to have the spring visit.
Mhm.
But I would never go back and not have a spring check-in meeting just because you can't remember everything for a year. So if your accountant allows you to have a couple of check-in meetings, even if it costs a little more money, it is well worth it, especially when you're getting off the ground. There's so much you can gain in all the questions that you can be asking. And then your tax return is fresh off the press in a
Mhm.
spring meeting, and you can be asking lots of questions and learning from that so you don't make the same mistakes again. The other thing, I would have one more piece of advice. In our books, we have a 911 account. It's like an ask my accountant, or if you don't know where to put something, instead of just like randomly throwing it in miscellaneous or randomly throwing it in supplies or randomly throwing it wherever, if you can have stuff in maybe like a 911 that, oh, these are the things I really need to ask questions about, it helps find those transactions easier than
Mhm.
them getting lost and putting, a question mark in the memo or something that
Yeah.
the accountant might miss.
That's really smart. Little red flag there. All right, so that's the bookkeeping side. Then we get into kind of the planning and strategy side. So let's talk through some scenarios there and some things that we can do depending on that to set ourselves up right. Let's say that we have a year that we have, a lower income than maybe we expected.
And I feel like that's kind of maybe where we're going to be with our farmers this year. If you're completely in just the farming side of things, I would say that the first couple of things, and you may have passed the deadline already for making some of these elections, but we're thinking big picture, right? We're going to talk about all of these strategies as not as if we're just talking about 2025, but in the
Hmm.
future. So we want to make sure that if you're in a low income year, that you're going to avoid deferring your crop insurance. A lot of people are going to have crop insurance that are on the yield and the revenue portion, and go ahead and take your crop insurance for the year. You can elect whether you're going to defer. If you're in a government contract like CSP or EQIP, you can often defer those payments until after the first of the year. So let's make sure we don't defer those payments and go ahead and take those into the low income year. I think sometimes we get into a habit of, this is what we've always done in the past and this is
Hmm.
how we're going to do it this year. So If you're in the habit of prepaying your seed expense because you get XYZ discount from the seed dealer, or you always get your hay in the fall and you just don't want to be caught without hay after the first of the year, maybe just think outside the box and defer any expenses or prepay less if you know that you're coming into a low income year. You can always adjust depreciation. We said that there's a set number of years for assets. This is something like, it's a very complicated tax strategy for depreciation. So make sure you're talking to your accountant, but there is a possibility of stretching that depreciation out over longer term years, depending on the asset. One thing that when we were first starting that we took advantage of quite a bit as we were growing our business, like I said, my husband's a mechanic. So we would often purchase equipment for really great deals, but they needed big repairs on them. Even with that, we knew it was going to be a great deal, but you can capitalize large repairs. So for instance, say you buy something and it needs a $15,000 motor or transmission, or you buy a planter and you upgrade with precision technology. And we know that that's like $1,000 a row unit. And if you have a 16 row planner, that's $16,000. Well, you can actually put that on your depreciation schedule. And instead of taking that repair in 1 year, you can do that over 7 years, or depending on what the asset is, but typically like a 7 years. So that would really help if you have a lot of those in a year, is to just spread those repairs out.
And with these things that we're doing, we're either deferring expenses or maybe doing less prepay or making sure we take those contract payments up front. The goal here, right, is to make the gap between income and expense smaller. How would you say that?
Yes. Remember, on your Schedule F, it's going to have your ordinary income and your ordinary expense in addition to your depreciation.
Mm-hmm.
Okay. There's one line on that Schedule F that you're going to have is depreciation. So instead of taking, all of that depreciation expense over here you're trying to get your Schedule F not so negative. Not that having a negative, sometimes you need to have a negative Schedule F to offset some capital assets that you sold. There's always a balance, and you need to make sure when you're doing your tax planning, you're taking both your Schedule F and your asset purchases and sales and balancing those out. But yes, you're trying to get to where you're finding the sweet spot for balancing all of those different income and expenses out.
And then you mentioned some of these things that we have to be making these decisions, sooner in the year. There's deadlines for those. Do you know what some of those deadlines are that maybe we need to be aware of, or maybe even some, if we're not used to looking for these clues, some clues that this may be a low income year, that we can be making these decisions not in December?
If you're kind of sliding into August, you should probably have all of your fall crops in the ground and kind of have a general idea of what they're looking like, and being able to project bushels and some sort of price, right? Mm-hmm. The prices have been absolutely crazy.
Yeah.
It's been a very unique year this year, and you should have your number of calves that you have on hand, so you know how many calves you're going to have for sale. And the cattle market it's been really, really great. Right now we're on this roller coaster. It was limit down again today, limit down Friday, I think. We can be doing pretty good projections in that August timeframe to know what we're staring down the barrel of. We might not hit the nail on the head, but we know if we're going to have a negative year or a positive year by August, right? And then as you get closer and closer, like your quarterly profit and loss, you should be able to spit that out of hopefully your bookkeeping system, and then be able to project those last handful of months, because you're close up to the markets and you're really finalizing what you're coming in through harvest and calving and weaning into.
So those are some of the things that we can do. Are there any other things in a low income year that we can be thinking about?
One of the things that it's important is, especially if you're a young producer, we really need to consider electing the self-employment option, even if you have a Schedule F loss. So the self-employment option is something that only ag producers have the ability to do. But even if we have a loss, we can pay into Social Security, and we pay on the gross, not on the net, if we have a negative Schedule F. And what that allows us to do, see, if you're a young producer and you haven't had a lot of off-farm income, it's going to allow you to pay in some quarters of Social Security. because remember, you need 40 quarters of Social Security in order for that to pay out. Basically, if you get to retirement and you haven't paid in any Social Security, and you could have very low Social Security benefit if you haven't paid into Social Security. So the other thing too is, if you're a young family, and we always hate to talk about a disaster, but if you haven't been paying into Social Security, and for instance, say you're the husband who's been reporting on the Schedule F, and you haven't been paying into Social Security because you're building your business and it's been at a loss as you are in the startup phase, then if something would happen to you, your wife and children wouldn't have Social Security benefit, death benefit. So I think it's really important sometimes, as you're submitting your tax return, between child tax credits and dependent care credits and all of these different credits, you can elect the self-employment option and still actually receive a refund because of child tax credits. So I can't tell you over a podcast how that formula works, but I can just say you need to make sure that you don't just shut the idea out of electing the self-employment option and just being in a position that you're not going to pay taxes, because having that safety net of paying in a little bit to Social Security so you have that benefit is really important, especially when you're young and starting out. Your accountant should be able to run numbers with and without that and kind of share what the difference of those would be. I'd always be like texting my clients like, okay, it's this with it, that's this without it. Can you afford that this year? And sometimes we could and sometimes we couldn't. And just, I think it's just important to know that's an option, and that paying no tax is not always the best strategy. I would say that if you're coming into a low income year and you have been putting into traditional IRAs, and you could fill a negative adjusted gross income, you could have some flexibility. There is no reason why you might not want to roll that into a Roth IRA, and that has to be done before the end of the year, just to go ahead and get some of that out of the way and eat up that loss. And then when you are taking out of your IRA eventually, that you'll be able to have that tax-free instead of a taxable item off into the future. So that is an option if you have some IRAs that you can use. That's a really good strategy. Hopefully you'll be sitting down with somebody who's just really great in that area and will help you strategize and take the time to mentor you in preparing for those low income years. And honestly, sometimes your loss does carry forward, but just remember, still in this big, beautiful bill, your loss is, you can't carry your whole 100% of your loss forward. It's 85% of your losses. Don't expect if you have $100,000 loss in 2025 that you're going to be able to carry that whole entire thing over into 2026. That's another strategy.
So that's kind of a low income year, a couple things we can do, but those are, again, things we have to be preparing for. It's not like we can get to December 30th or whatever and be like, oh crap. So another reason to kind of stay on top of the record keeping so we have the information we need to make that decision. Let's look at the flip-flop, the high income year, which I think for a lot of cattle producers, we are potentially dealing with that this year. Definitely we're dealing with it last year, depending on how diverse you were. But what are some of the things that we can do in those years?
Right off the top, an election on everybody's tax return is farm income averaging, or the Schedule J. And to summarize that, it looks back on what tax bracket you were in for 3 years. So if you were in the 10% bracket and then the 12% bracket, and this is a perfect time to mention that, the tax brackets are always coming up in the big, beautiful bill. The tax brackets are going to be staying the same instead of, there was a time that we were at a 15% bracket and up. We still have those lower tax brackets. And that was part of the big, beautiful bill that will still continue to have those lower tax brackets. Sorry to go back. I'm kind of
that's a good thing to know.
So if you're in the 22% bracket this year, you can take a portion of that income and you can fill those lower tax brackets and still paying your income tax, but you're at a lower tax bracket because you're using your past 3 years. If you had 3 years of low income and this year you happen upon a high income year, you can utilize that income averaging. That's something probably behind the scenes that your tax preparer is going to be doing, but it's something if you get looking at your tax return and you're like, what is this Schedule J? It's a really great tool that we can use. Not that we're deferring or, signing up for wonderful grain prices and contracting all our grain this year. But in future years, if we have some great grain prices and we want to make sure we lock those grain prices in the fall, remember that we can use deferred grain contracts and get our grain contracted in the year that we're harvesting it in, and then sign up for the deferred grain contracts. The beauty about deferred grain contracts is we're allowed, if we have those completed properly, that we can pull those in back into the year, and we can situate our grain contracts. If we are really wise, we can put them in smaller increment contracts. So say you want to do some 1,000 bushel contracts and some 5,000 bushel contracts and some 10,000 bushel contracts. That'll allow your accountant to pull back the exact amount of where you were wanting to sit at the end of the year. One thing I would caution there was a little while that a co-op in northern Kansas were doing these contracts called defer on demand contracts. And yes, they were contracts and they were establishing the price and they were signing off on it, but they could go in and get it anytime. They could get it at the beginning or at the end of the year, or get it at after the beginning of the year. And defer on demand grain contracts are not the same as deferred grain contracts. If you sign up for a defer on demand grain contract, that is like constructive receipt, and you're actually taking in the income, the full amount of the income. So I would just caution you, if your contract is saying defer on demand, don't utilize that as a tax planning tool. Plan on paying the whole amount of taxes on those. We just had a handful of clients that ran into that, and of course, it said in little letters at the bottom, consult your tax advisor for utilizing this tool. And I think they were kind of telling producers that you could defer those, but you cannot. It was on an advertisement and looked extremely legitimate. And I think many producers were kind of under the impression that it would work both ways. It does not. Also, in a high income year, of course, we talked about not prepaying expenses for low income years. We can prepay expenses for high income years. I guess, that's a wonderful tool to use, but I would just throw out a word of caution that we want to avoid a snowball in the future years and make sure you're planning for the next year's tax liability. I mean, of course, if you're making some major changes and you've decided to sell the cow herd, or you've sold 2 years worth of crops in 1 year because of some other tax planning strategy or management issue that you had, prepay some expenses, but don't get yourself into trouble that you're prepaying so many expenses to avoid taxes in 1 year that you have no expenses running into the next year. There are some rules in prepay expenses also. So you can't write off all of your expenses for the following year, and the IRS has some rules against that. So just be cautious. I guess we can jump right into depreciation. In high income years, we can use accelerated depreciation as a tool. So bonus depreciation, according to the Big Beautiful Bill, resets to 100% permanently for purchases made after January 19th of 2025. In previous years, bonus had a step down, 80%, 60%, 40% is what we could use to bonus, and it's back to 100%. Anything that we purchased January 1st through the 19th, only 40% of bonus available. Remember, that would be the day that Trump took office. So that was put into effect. So if you had some assets that you purchased in that tiny window, be cautious of that. Just remember that buildings and farm equipment, anything that you purchase that you're going to put on your depreciation schedule, it needs to be in use. We can't purchase a building and have it delivered to our place, but no progress to be made. It has to be built and in use before we can put it in our depreciation schedule. A young couple and they were just starting out with us, and I had gone to their place and they needed a sprayer upgrade. I was excited for them. They'd made the money. They got their sprayer, we bonused it. They paid cash for it. We get to the next spring and we were talking about how hard it was for them to get this sprayer on their operation. And they had to do some custom pay for some custom spraying, and he was really frustrated. And it was kind of a mic drop moment for me. And I'm like, this is a young couple and they're new to our association. And I don't think they even realize that you have to have it in use when we take it on your depreciation schedule. So just be cautious that you get to the end of the year and you're like, oh, I need to go buy something to write it off because my tax liability is going to be really high with cattle sales or whatever. If it's not on your place, you really shouldn't be taking bonus on it or accelerating depreciation or section 179ing anything. That kind of caught section 179 and bonus. So section 179 is also another method that we can accelerate depreciation. The expense limit for that has increased to 2.5 million and it was 1.25 million. So in the new big beautiful bill, that will be a nice change, that we have a little more flexibility in the amount that we can use. And it phases out starting at 4 million and it was 3.13 million. I think the nice thing about section 179, it is per piece of equipment, right?
Okay.
And bonus is 5-year asset, 7-year asset. Those all would need bonus, like whatever assets you have in each of those. There's just some things that your accountant will have to help you work through as you're trying to make decisions on utilizing bonus depreciation in section 179. The thing I would caution people about using section 179 or bonus is if you choose to purchase a piece of equipment and you have a payment on that piece of equipment, just remember if you depreciate it, then as you're making those payments in the future, you don't have the depreciation to match the loan payment that you're needing to make, and principal is not deductible. Okay. So if you bonus a piece of equipment or you section 179 a piece of equipment, you're going to set yourself up for some tax trouble in the future because there's no depreciation to offset the income that you need to generate to make that payment. I just recommend match your depreciation with your loan payments. There is a couple of tricks of the trade that if you're a very giving operation or individual and you write a lot of checks to charities or you want to gift to family, there's the possibility of commodity gifting. For instance, say you are generous and your church is a place that you give, you can actually gift grain to your church. The only thing is it needs to actually be put in your church's name. You can't sell it and then give them the check, right? You need to give them the grain and the church needs to market the grain. And just remember, that comes right off and allows less gross income if you're gifting grain instead of writing a check. There's some charitable giving deductions is less than if you would gift grain, right? Okay. So we can use that as a tool. And you can also gift grain commodities to grandkids, family members. And I think that amount is 19,000 for 2025. Keep that in mind. It has to be changed into the person's name. Retirement contributions should be considered if you have a high income year. You can put some funds into retirement and offset some of that high income year for yourself. And just remember, you need to be setting up those accounts before the end of the year, but the contribution doesn't have to be made until April 15th. So keep that in mind.
Okay. Of the following year, right?
Yes.
Okay. That's a lot of things that you have the opportunity to do. And it's kind of overwhelming to think about, especially the depreciation choices. I feel like because those do have such an impact on future years' taxes. So definitely just knowing that there are options out there. So if you're coming into your tax appointment, and I think a lot of preparers are not going to give that information to you unless you ask the question. So just knowing that these are options so that you can ask those questions is important.
Right. I remember thinking, gosh, I wish I would have had this background when we first started. And the thing is, so many of us don't even know what questions to ask, right?
Exactly.
So it's like this depreciation is one thing that, and it's always a burr under my saddle. I'll just be honest. When people want to purchase an asset and write the whole thing off the first year, but then they have a loan on it. And it's like, oh, you're setting yourself up for such a disaster in the upcoming years. Just please be cautious that you need rollover depreciation. You need, your asset base and your depreciation schedule. If you can start out with some depreciation that you're rolling over from assets that you've purchased, you're just giving yourself that leg up. And keeping your income matching your depreciation schedule so you don't set yourself up for failure in the upcoming year, because there's nothing worse than trying to offset one year and then end up paying for it in the next, and
Right.
you're up in a high tax bracket because you were trying to avoid taxes
Yes.
in
And
previous years.
I think that seeing those numbers laid out in your depreciation schedule really helps. Every tax appointment I've ever been in, you don't see the depreciation schedule. And so it's kind of hard. It's a hard concept to grasp sometimes. So I think especially for young producers or a producer who's maybe just started another segment of their business and they go buy, like you said, a sprayer to be able to do some custom work with on the side, they want to, like, that's exciting that they get to write that all off because but you have to be able to see that long-term plan.
And when you're to the end of your year and your taxes are all finished, there should be a depreciation schedule in there. And I know, like in our tax software, we could select whether it printed or not. So if you're not getting your depreciation schedule with your tax return, that's something you can easily ask your accountant for. Do you mind getting me a depreciation schedule? And then making sure, if you can't find it on your depreciation schedule, ask, what will my depreciation rollover be for next year? What will I have in depreciation? Because every year, some of your 5-year assets are going to drop off, some of your 7-year assets are going to drop off. But if you know that, okay, rolling into next year, I have $20,000 in depreciation. So like if I've made $100,000 and I have $80,000 in expenses and my rollover depreciation is already $20,000 before I even started purchasing an asset, then I'm at net zero. And I don't, like on my Schedule F, I don't owe any taxes. So if you kind of come into the year knowing how much depreciation you have right off the bat, that's really helpful. And I bet you not very many of us would think to ask, okay, what am I starting with here?
Right. Yeah. And I feel like that's something, like you said, at that spring meeting where you've just gotten your taxes submitted, that's an opportunity that would really make sense to be asking some of those questions. And I mean, I feel like so many of us have the opportunity for these appointments with our tax preparers, and we either don't take them or we show up and we just try to do them as quickly as possible because we have other things in our day. It's like putting in even just the little hour at this tax meeting or whatever it is an opportunity for you to really have a good eye on what's going on in your business that you probably aren't going to get anywhere else.
Right. And I think the most important thing is, like, if your records are clean and your accountant's not trying to like find out where all these capital assets are going and coming from, and they're not trying to fix all these income and expense items, then you would have time to talk about strategy and mess with depreciation. But if you come in and your tax planning meeting is only as good as your record keeping, right? So like if they're trying to clean up a bunch of stuff, that doesn't give a lot of time for the strategy side of things. So the harder you work and the harder you try it, those kind of things, the more opportunity and time you have to, because there's a lot of you coming in for these appointments and we only have so much time in a day, right? And so if you want that, you got to be working hard to keep things clean. And the other thing is just try to be reading up on, like, the University of Nebraska had posted on an update on the big beautiful bill. There was several different things. If you run across something and you're like, oh, child tax credit, like this is coming up, it's $2,200 starting this year, like how is that going to affect my tax return? You kind of have to be in the background keeping KFRM, the ag radio station. I'm terrible about just hitting Spotify and listening to that all day, but I need to keep up to date with what's going on in the background just a little bit so I can be asking my accountant, how is this going to affect me?
Well, I think that's a perfect segue into kind of what's going on this year and thinking about the big beautiful bill. I don't want to get too in the weeds on it, but maybe what are some of the high points or things that, are definitely going to affect some people and we need to be asking questions about?
I think I'll just start kind of going through the laundry list of things that we are getting to keep. The qualified business income deduction is going to still be in place. It started in 2018, and basically it's like 20% off the top of your business income that you don't have to pay taxes on. So if you have $100,000, then 20% of that's not taxable. It's a huge, huge benefit to producers. They did increase the limit for the range for phase out. If you have qualified business income, a minimum of $400 on that. So that'll be big. Starting January 1st of 26, the lifetime estate and gift tax exemption increases to $15 million per person or $30 million per couple. And that's going to be big for us. Operations get to be pretty valuable pretty fast, and 3 million would have been pretty devastating to some of our operations that are trying to pass on their from generation to generation. So this has been made permanent, and it will be indexed for inflation. For 2025, it remains at 13.99 million, and there's no change for the annual gift tax exclusion. It's, like I said earlier, 19,000 in 2025, with step up and basis rules still in place. I mentioned quickly that we still have the 10% to 37% tax bracket. So that's a blessing that we are not having 15% or whatever is our minimum tax bracket. For itemized deductions, or the state and local tax deduction, has been raised temporarily for 25 through 29 to 2029 from 10,000 to 40,000. And that'll be indexed for 1% a year. There's some specific rules and guidelines of that, but if you're an entity and can take advantage of SALT, go ahead and pay in on the state tax side of things so you can utilize that deduction. Charitable deductions for $1,000 for individuals, $2,000 for joint filers will start in 2026. The other thing is car loan interest can now be deducted for personal use vehicles. Your interest is always going to be deductible for farm use vehicles, but for personal use. So this kind of goes not just for ag producers, but for everybody. It's in effect from 2025 to 2028. It has to be brand new. It has to be assembled in the United States. It has to have 2 wheels, and it has to be primarily used on public streets, roads, and highways. And it has to be less than 14,000 pounds gross vehicle weight. So there's some stipulations in there, but if you are buying a new vehicle and you're not splitting interest, it might be beneficial to do that, because that will be deduction that you can take advantage of. For seniors right now, there's a temporary deduction of $6,000 per person, age 65 and older, with income under 75,000 single, or 150,000 married, for 2025 through 2028. These have been the main things in any tax schools that people are going to, and tax software will have these updates. The premium tax credit, a lot of people are on Obamacare and they're turning in their AGI and they're getting a premium tax credit. One of the things that's really important, I feel like, as ag producers, is our income fluctuates everywhere, right? And from year to year, it's really hard to predict what our adjusted gross income is going to be to set our premium tax credit. Just know that families that are over 400% of the federal poverty level will not be eligible for any premium tax credits. And, if you didn't plan on selling calves and you sold calves and you got a great price, that's wonderful. But when your accountant comes and says that you owe quite a bit more on your tax return, probably a big portion of it is going to be that premium tax credit, not just income tax. Okay, so be prepared for that. The main thing is, if you underreport income to the marketplace, you could owe all of that back. Just try to report your income as accurately as possible to avoid a surprise at tax time. If you take advantage of that program, that premium tax credit, just make sure that you have this huge tax credit so you don't have to pay a tremendous amount in your monthly premium. So they're going to supplement the premium tax credit. So you may end up having to pay some of that back if you're higher than what your adjusted gross income that you projected is. It's frustrating, because I feel like, especially as producers, as we're trying to grow our operations, a lot of times we're like, okay, what kind of year are we going to have? Do we say we're going to be at an AGI of 60 and then we end up at an AGI of 80? Well, then that causes us to pay more in the premium tax credit plus more in income tax, and it just gets so overwhelming and frustrating. And I feel it was always just a frustrating situation to be in.
I agree. It just makes it really difficult to plan.
Yes.
All that does for everybody.
That is such a blessing and a curse, to have to find that balance, but it is what it is. Child independent care tax credits, 2025, permanently increase that to $2,200 under age 17, and that'll be indexed for inflation starting in 2026. And then a $500 dependent care credit. So like my daughter who's off to college, she doesn't qualify for the child tax credit, but she will qualify for the $500 dependent care credit as long as she's in college. There's a few stipulations, and your accountant will know where those land.
some of these things that we're talking about, it's hard to go into your tax appointment with a list of, did we get this deduction? Did we get that deduction? And not feel like a jerk. Are there ways that you can kind of like look on your taxes to see if some of these deductions are being claimed, or what's a good way to approach
Yeah,
that situation?
sure. If you're not an entity, right? So you're filing a 1040, right there on the front, you just kind of have to read line by line. Okay. And on the second page of that, it's going to show if you've gotten your child tax credit and your dependent care credit. It's going to show if you've paid into self-employment. And a
Mhm.
lot of times it will say, see schedule, whatever,
Mhm.
and it'll
Yeah.
refer you to a different schedule or schedule a supplement.
Mhm.
So you're going to be flipping through pages. And the main thing is that tax return is there for you to look at, highlight it, show the references, read through those. I mean, yeah, it's not going to be the most enjoyable reading for your evening, but don't hesitate to just try to read through there and read it line by line and see if you can kind of make heads or tails of it. And if you have something that you want to circle and ask during, a spring appointment or after. I think the main thing is, please give your accountant grace and maybe wait till a few days after that April 15th deadline before you bombard them, unless you see that honest mistake. Like if you
Mhm.
get to looking at your depreciation schedule and you see, wait, like the tractor's only on there for 40 and that was 80. Like,
Mhm.
of course, it's always great to be able to get a correction in on that versus having to amend the return. But if it's just general questions of you wanting to understand your tax return, they have so many people they're trying to prepare behind you that if
Yeah.
the questions could wait till after deadline, it'd be really great.
Yeah. And that's definitely understandable. And I think honestly, most of us, just talking from a standard scenario, we're not looking at that. It's like after taxes are filed, oh my God, thank God.
Yeah,
It's we want to wipe our hands of that and be done with it, unless we feel like we didn't get a good deal or,
right.
somebody didn't do their job. And then we're combing through that thing, trying to figure out what's going on. Some of the things that I think are important, like you said, give your preparer grace, wait until they're not trying to take care of 75 other people and you, and then really like you have an opportunity to file an amendment if you need to, and then you have an opportunity to ask those questions that are going to help you prepare better for next year so that maybe you can do a better job of either coming to the meeting prepared or knowing what questions to ask to make sure you're getting the service that you need. One thing I want to bring up is quarterly payments because I feel like they can be great or they can be really awful. What kind of approach do you guys usually take?
Well, I think quarterly payments are, if you're a person that does not like to have a big lump sum of taxes at the end of the year, and that gets really frustrating for you, then quarterly payments are great. The thing I tell producers is you can make your first and second payments. And if you end up not needing to make a third quarter or a last quarter payment, you
Hmm.
don't have to make those. If you see that your income is coming in much lower, then no harm, no foul, right? And you've just kind of made those payments and made life a little easier. The other option, if you don't want to make quarterlies, is doing a January 15th estimate payment. All ag producers have the option to do a January 15th payment. So it would be 110% of your previous year tax liability or 90% of your estimated tax liability that you're going to have for the current year. So you can make that January 15th estimate payment, and that gives you a little more time to get all of your tax documents in, and you're not trying to meet that March 1st deadline. And that just kind of takes a little bit of pressure off of everybody in that. I do think it's good. We have the March 1 filing deadline for farmers. March 15th is for corporations, S corps and such. So there's a lot of things going on for an accountant and tax preparer, a lot of deadlines that they're trying to meet. And so sometimes having that blessing of being able to have some of, if you're doing only farmers, then it's really nice to have some of them not due until April 15th, right? And if you've paid in quarterlies or a January 15th estimate, that just lightens their load just a little bit and makes
Gotcha.
sure that your tax return is not done in the rush of just trying to get everybody out the door kind
Yeah.
of thing. It's been really interesting. I've had a couple of producers that are like, we're just going to pay as little tax as possible. And I think everybody has their strategy. The strategy that I like to see people go with is maximize after-tax wealth.
Okay.
Try to build wealth with after-tax dollars. And if you're always purchasing something at the end of the year to avoid taxes, you kind of have this monument to tax avoidance, and you could set yourself up year after year to get yourself in trouble. Paying tax is not a bad thing. In order to build your business, you have to make smart decisions. Sometimes a smart decision is a tough decision, and you may need to pay some taxes to get that done.
And I think, there's a good balance to that. And the best thing that we can do is set ourselves up to make those good decisions, not at the end of the year when it feels like a lot of pressure and it feels like a lot of last minute things need to happen. So like you said, keeping those records as a tool for you to use far, far before November, December is going to be the best option that you have. I mean, this has been a great coverage of this topic, Tressie. I think, it's not always fun to talk about, and it's not farmers' favorite thing to do, to sit there and comb line by things, but it's part of the job and it's important if we want to be successful. Thank you for sharing this knowledge. If you had maybe one takeaway for folks that you would encourage them of why this is so important to their operation, what would you tell them?
I have really enjoyed my time that I've invested into Ranching for Profit and the Executive Link program. And one of theirs is the Pareto principle of the 80-20 rule. As farmers, I think we decide that we just put our nose to the grindstone and work. But we need to look up, and we need to make sure that we're spending 80% of our time working in the business and 20% working on the business. That 20% is going to gain us so much. Try to keep it in perspective and keep a balance. And 80-20 is a great place to start. And as you grow your operation, you might find that you need to do more than 80-20. But if you're not dedicating time to good planning and good preparation and record keeping on that side of the business that we don't love so much, that we could raise all the great crops and all the great cattle in the world. But if we can't stay on top of that planning side, financial management side, we might be spinning our wheels in our operation.
And that's never fun to do.
Right.
Be working that hard to spin your wheels. So I really appreciate you coming on today, Tressie. If folks have questions or want to follow up, where can they do that at?
I'm not official anything. I don't have business in the background that I'm trying to push. Husband and I are just expanding our operation and loving the ranch side of things and just trying to make a go at that. But if you have questions that you want to direct my way, you can find me at tressiemitzner@gmail.com. That is one that's not overloaded with junk mail. And my name is a little hard to spell, so I'm sure that it'll be in your show notes, but it's TRESSIEMITZNER@gmail. Reach out. I will try to answer your questions as best as I can. And if I can't answer it, my philosophy is if I can't answer it, I'll find somebody that can for you or point you in a direction, and somebody that's more of an expert than I am.
If you've enjoyed spending time with us today, please take a moment to review the podcast on Apple Podcasts or join the conversation on social media. Do you have a topic you would like to discuss or know someone with a story to share? Apply to be a guest on the podcast at farmingonpurpose.com. You can follow the host of Farming on Purpose, Lexi, on your favorite social media platforms for more content by searching for Farming on Purpose. And remember, if you look around your table and aren't inspired by the people there, it's time to find a new seat.